At the 20th of December, a student of mine, while I was trading with him in a meeting, he made over $1,300. And we're going to break that down because some people think we cannot make money day trading when there are holidays, but this is not true. Why? Because businesses and also people in the end of the year see how much money they have and they're going to reinvest. In this case, we call this one a cry out because it's in the end of the year. And what happens very often is either we see that the market is going very up or it goes very down, and just for a period of time of 15 minutes to up to even 8 hours at some days. And this day was pretty nice. You can see here, by the way, this is his account number here, but I was hiding it here a bit so you can't see correctly the account number, but it doesn't say simulation here as you see here. It was trading a real money account with 107 tick. The move 107 ticks in the future industry. We talk about the S&P 500 futures. So that's $12.50 for each tick we make money if it goes in our direction times 107. So we're talking here about $1,337.50. The trader only lost, as you can see here, minus 10 ticks it says here. So this is like 112 ticks for one time, and he lost one time $30, and that's it. So it means he used $200 to make $1,300 money. So when it comes here to the cry out, we call this, is that we see that the market does more green than red candles, as you see here. And we have down here a consolidation phase. There are two factors that are very important. And the one thing is the consolidation phase in the bottom. That means how big is this consolidation phase here? And how long is this one? The more bigger this consolidation phase is, the higher is the chance that the market is going down. The shorter the length and the less green candles we have here, the higher is also the chance that the market reverses. So it's sort of always of a combination. What happened here is that, as you see here, the market literally was pushing out here very strong higher. So that means even though we would have here a very long consolidation phase, the market has very often, when you look to the left here, specific highs on the left side. Because if the market is going up, the market wants to go to specific highs, to specific references. Here, for example, you can see the yesterday highest point and the market was exceeding it. And the reason why the trader still was buying here was, the first one was liquidity. That means we have a tool that we can see that the market wants to go there. This is called the heat map, and you can see this one here on the left side. So it shows us, as you can see here, 267, and it shows us here 659. So you can see it's 60-46, somebody wants to sell, and on the bottom side, somebody wants to buy here, for example. And when there's a very big number at the top, it just shows everybody on the exchange, hey, I want to sell here a lot. So it indicates us for us that it makes sense that the market goes there. The second thing is that when we see that the market is doing a specific length per time, that means here you can see like 10, 15 candles, the market did this length, and the next 10 to 15 candles, the market did around 80% of the same move. We can expect that when we see retracements means because the market is always rotating, goes in one direction, comes back, that the market comes back and then starts to make now the same length as you see here, number one, number two, and if the market does here number three, this is exactly the length that we expected because we have here liquidity. That means, as I showed you, to make it so simple as possible, there's a tool that you pay money for on the exchange, that you see how much is being traded. This only works very well with the S&P 500 futures and of course to its US session. You can see here on the volume here a mountain, and this means also there was a liquidity. By the way, you can see here exactly here, this is the VPOC here, by the way, this is where it came from. It means the market was going here. Here was somebody saying, like, for example, he wanted to sell 500 or let's just say like 350 pieces. Usually you see like on each price 80 or 115. And then the thing is just, if the market is going there, we need to look for it. How much is really being traded there? And there's a tool, this is called the footprint chart. So this chart here, for example, reveals you exactly how much is being traded there. And of course, if more is being traded higher, that means it's sort of an acceptance because it shows that people are comfortable trading higher to expect also higher prices. So the question is now, why not going out of the trade? And the main answer here to this one, what is very impressive is, it's about how to use, for example, when we have like a $3,000 account and we take $1,000, how can I take $200 off for the day and make $1,300? The answer is a good trading strategy that shows you, okay, if I see more green than red candles, if I see that the market does specific length, that means in this area, if I would expect that the market does the same move again, and I have a small trading pattern, that means such as a color switch as you see here. If I have now enough leverage to enter here the trade after the color switch, as you see here, to place the stop placement under the color switch, then the thing is always, I would lose $100 if the market goes against me under this point. But if the market goes up here to this point, how the trader did, then this one would be a $500, $700, $800 move. So now we have mathematics inside. I'm going to draw in here, by the way, the trades that he took. This was from here to here. He was a small stop out, and then he took a trade from here to here. And then here to here, he used the heat map to have a very tight stop placement, but the risk reward ratio is just so important. I'm going to show you why. Because the thing is, if we can adjust $100 an average to make $500, what happens is that sometimes when people trade in the beginning, in the first 2 years, people usually have like 4 losses to 7 losses in average. That means they lose $400 to $700 if they work properly with the money management. But the other 6, or this is something that's very important, 6 or 3 wins of $500 can be literally $1,500 to $3,000 in making money. And the thing is, if you lose every time $400 or $700, but within 10 trades you make always $1,500 or $3,000, you start making money. And this is something what is very important. Now the thing is, what is about the time and how to actually do that? And the answer to that is, if you trade the S&P 500 future is very important. If you would do this, by the way, not over trading futures, you will pay too much in commissions. We're talking about $2,000, $3,000 more in commissions. And that's like, if you make like $1,000, $2,000, $3,000 a month, or if that's your target, or to go to $10,000 a month, if you pay every month then $2,000 more on a spot market, it means this Forex thing, what you can trade with your phone, then you have just literally a negative money every month against you. And this is why it's so important, of course, to trade futures. The other thing is the trading strategy gives the solid opportunity to trade only 1 or 2 hours a day, what is absolutely awesome. 2 times, 3 times, 5 times a week, however you can. And the other cool thing is just, it's all about trading signals. It's called a pipe. I call this always a pipeline. That means when we adjust, for example, when we can adjust $100 to make $500, that's a trading opportunities. For example, if it's a color switch such as a red and a green candle, or here a red and a green candle, or here a red and a green candle. Now the thing is, how many times can I see a small color switch? For example, we have here 1, 2, 3. And in this case, only number 3 is small enough that when we adjust $100 with the entry after the green candle and the stop placement below, that this is with the average length, a risk reward ratio of 5. So that means how many times, if I'm trading for 1 or 2 hours, how many times can I see that I can adjust $100 and get $500 afterwards first when sitting on the computer in the US session time for 1 or 2 hours anywhere. And the thing is, when you have a 1 minute chart, we have 60 candles within 1 hour. When we have more green than red candles, I think it makes, of course, more sense to trade a green candle. This is the logic behind and also the practical side. So you see here 1 color switch when adjusting here $100 until here that would be 500. What would have worked? You see a red and green candles here. Until here, it would be $500. Here you see not a single color switch as you see here. And these color switches, they are too big that if you would enter here the trade and adjust here $100, the $500 length would be somewhere up here, would be too long. Now the thing is, there are also advanced tools such as the heat map. And this was the reason how the trader was trading it. But before using the advanced tool, literally trading the color switches first, having a proper trading strategy as I explained. Hope this helps you out. Wish you all off. Good trades. JT out.